This is an incoming transmission from the Jersey Shore.
This is Financial Insanity with Scott McLean, powered by McLean Advisory Group. Today you'll hear some of the most important financial information and wealth-building techniques available anywhere.
Let's get this party started, huh?
Do you have a question for Scott and the team?
Am I on the air?
609-488-4646. That's 609-488-4646.
We'll get that information to them by radio.
Now, Financial Insanity with Scott McLean.
Hello, everyone, and thank you for joining us for another edition of Financial Insanity. I'm Alex Dingman alongside Scott McLean, McLean Advisory Group, financial advisor in the area for decades now, and you're helping people navigate their investment choices, Scott, as we have a very special topic today. But first off, it's great to see you, my friend. Hope you're doing well.
Oh, man, thanks so much. I'm so excited to go over this topic, which most people forget about, Alex.
No, absolutely. And you just love pouring into folks and really just kind of uncovering things that maybe people didn't know. And you don't know what you don't know. And then also what we're going to talk about today is it is great to grow your money. We want to grow your money over time, but we're going to talk, Scott, about how there is a shift when you get to retirement. And you got to be talking about that income because you don't have those paychecks anymore. So we're going to get into that more. But first, let's just talk a little bit here about some basics. Investing for income versus investing for growth. What are we talking about? Put this in simple terms for us, Scott.
I like to use the analogy, the chicken and the egg. You see, as a chicken pops out eggs, you can either choose to eat the eggs or the income, dividends, or you could let the eggs continue to grow, reinvestment of dividends, and buy another chicken. So you can grow your wealth organically by the investments you're buying, and those are called income-producing tools. With the market skyrocketing like it did, I should say interest rates skyrocketing did, you saw income tools drop. Why? Because you bought maybe bonds at 1%, 2%, 3%, but now you might be able to buy bonds, preferreds, REITs, BDCs, MLPs, income-producing tools at a much higher yield right now. And so the question is, what do we do? So investing for income versus growth is the number one biggest mistake for seniors that are heading into retirement. Understanding the difference is why, Alex, when you asked me to talk about this, because no one's really bringing it up in more detail, I wanted to talk about it, Alex. So thanks for bringing the show up to me.
Very, very, very wise for us to address this today, Scott. And the number for folks, if they have questions here about investing for growth versus investing for income or anything that we talk about today, the number 609-488-4646. Again, that number for Scott and his wonderful team over at McLean Advisory Group, 609-488-4646. Locally here in Waretown, New Jersey, but obviously going to help everybody in Ocean County shore up their retirement future. Now, Scott, I know you talk to a lot of folks, and these people, investors, they have concerns. What are some common concerns for folks that are investing and things that you would address? What are the things that you tell folks?
When you invest for income, you're investing for maybe like you go to the mailbox on a monthly basis and you expect a check to show up. Steady income. But on growth, let's say you're buying a stock and the stock market goes up and goes down. So you could have major shrinkage if the market takes a left hook and starts to drop. And now can you get that check? Well, that's the problem. And how you pull money out of your portfolio is so critical and such a lost art. Because if you're growing money, let's say you bought a company called Tesla and you bought it at $100 and you sell it at $200, you made tremendous growth. But did it pay a consistent dividend? Nothing wrong with buying growth stocks. But if you're living on income and you have growth stocks, you could actually evaporate the portfolio because you have to sell off shares of stock to give you that steady income. But if the market drops, you actually have to sell more shares of stock just to keep that same income. And that right there is the secret. How can I not evaporate my money so I have a long life with my investments, and where do I put it? And annuities is not the only place, although it is a great place, but also investing in income tools. And that's what we spoke about when it comes to the show. When you look at the income tools, Alex, I'm looking for about a 4 to 8% consistent type of dividend, whether they're bonds, preferred, REITs, BDCs, MLPs, master limited partners. Some tools like that are paying a nice dividend that you can pretty much hope that they're going to continue to pay on. And now with interest rates as high as they are, could it be the right time to call our studios and say, Scott, is bonds a good tool right now for income? And I'm telling you right now, because of the interest rates where they're at, depending on when we're listening to the show, should I shift my portfolio? Because shifting out of growth into income is the hardest choice for anyone to make, because you're so used to looking at the bottom right number, Alex. So we want to look at income tools. We want to have that chicken that's continually popping out the eggs. I can eat the eggs, take the dividends, and put them in my pocket. Or do I want to take those dividends, the eggs, and maybe buy more chickens? Another investment. And this is the mistake of when it comes to income investing. This is the art of investing that's really lost, Alex.
Yeah, absolutely. And if you do have questions about income investing, that number 609-488-4646, 609-488-4646 for Scott McLean and the team at McLean Advisory Group. Now, income investing. You talked about a little bit, but very simply, what do we mean by that?
Well, Alex, I'd like to do the comparison. We took, and we look at here the year 2000, and the market took a tremendous drop. But had we had dividend-producing tools, we would have had a nice stream of income, but provided they paid the dividend. But if you had a growth stock, let's say the S&P, the Standard & Poor's, made up of 500 companies, or the Dow Jones, made up of 30 companies, and the market dropped tremendously from 2000 to 2002 to 2000, right around March, the market dropped almost 50%. Are you going to get growth? No, you've got shrinkage. And if you're pulling out money, you have to sell off more shares of stock, and that's called reverse dollar cost averaging, versus when you were putting money away when you're retiring, Alex. Say you're a young stud, and when you retire, starting your work, you're putting money in on a monthly basis, and whether the stock's high or low, it doesn't matter. You're dollar cost averaging, but it shifts when you start to take income, and this is the number one mistake seniors make. Not knowing how to shift out of the growth portfolio, because everybody loves growth. No one likes shrinkage. And the challenge comes down to, well, from 2000 to 2013, the market frankly went nowhere, Alex. It went nowhere. But if you had a 6% return on your money, let's say I bought a treasury, you made money on a consistent basis by way of dividend. Now, growth, everybody loves growth. You buy a nice stock, and the S&P stock went up from, you figure, when the stock market took a real poop from 2009, when the market took, everybody remembers 2008, the market dropped. But then from 2009 to 2020, the market screamed. It went from 7,000 to almost 28,000, that longer of a period. But there was some bumps and hurdles in that period of time. So again, when you're investing for growth, everybody loves growth. When it drops, you don't go out to eat as much. You get worried. Maybe your husband or your wife who does the stock, they're sitting behind the computer by osmosis are praying it's going to come back, but maybe it didn't. So maybe you're not bouncing your grandchild on your lap and having fun because you're worried about your money. But if you had a consistent chicken that popped out the eggs on a steady basis, you could enjoy life a little bit more. And again, remember, Alex, if I could say this 100 million times, everyone loves growth, like everyone loves cake and ice cream. The stock market gains, but no one likes cholesterol or fat or extra weight on your booty. Why? Well, that's the market dropping. No one likes that. So how do we fare that out? Consistent investing in the right tools to get that steady stream of income that you can depend on.
Yep. It might not be as sexy, Scott, as you get older and, you want all this growth, and it can be real exciting, the ups and downs, and typically up over time. But when you're income investing, that's reliable. Maybe it's not as sexy, but gosh darn it, you're going to need that in retirement. So that's the mental shift.
This steady income. Right. You're absolutely correct. And for those out there that are out there, if you feel like you want to give our studios a call, say, Scott, can you make it clear? Please, 609-488-4646. The staff will make you set up a time to have a talk. It is not a time for me to twist you or try to bend you or try to make you work with our firm. No, let's have that conversation, because this is a lost art. Remember, if I work with the stock brokerage firm, my love is stock. If I'm working with a real estate and I'm selling real estate, I love real estate. But let's put that in perspective. What do I need in my retirement? Maybe you have part of your portfolio is income, and a part of your portfolio is going to be growth. That's okay. So if the market does drop, you can look at one thing where most people are trained to look at the bottom right number. Hey, I didn't grow my account. The account went down. Well, that's okay. It can go down by stocks or bonds or preferreds or types of investments. They can both go up and down. But another number to look at is, did I get a dividend? Did I get by reinvesting the dividend? And this, again, is a lost art. So when the market is volatile, I can tell you right now, you need to look at those types of investments we can talk about in a second, Alex, the type of that are out there that you need to pay attention to. And this is where investing is really at its finest, of how you can really allocate your investments, put them in the right spots for your stomach ache. Or maybe you don't want a stomach ache. Maybe you don't want that Pepto-Bismol when the market dropped in 2008 to 2009 over 50%. Some accounts went down 60%. If you can't handle it, get out of the kitchen. But if you're going to get out of the kitchen, where else do you go? Income investing could be right for those of us listening right now. 609-488-4646. Please give our studios a call. No cost, no obligation, so I can help guide you through this untapped world of how does it really work and where do I go?
No, that's great. And I just want to hit again on the point that this is an introductory phone call. This is no pressure. This is not a sales pitch. This is Scott and his team really hearing you out to see how best they can help you with your retirement, with your finances moving forward. So again, that number, 609-488-4646, 609-488-4646. Just add a .com for the website. Well, next, we're going to be talking about the volatility factor. This is Financial Insanity with Scott McLean.
Hey, this is Scott McLean. I want to wish you guys a tremendous, wonderful holiday. Merry Christmas, Happy Hanukkah, and all the lovely greetings we have for you. Proud to be in your life as we try to give you the financial information so you don't go insane. Happy holidays.
Stop for a moment and think about this. Do you know how much money in your 401k or IRA is actually yours? Or will the government take a bigger chunk than you thought? Remember, you still might owe taxes on that money, but do you have a plan to help make sure you don't pay more than you should? At McLean Advisory Group, we believe you deserve to keep more of what you've earned, which is why we're here to help you navigate the confusing world of retirement taxes. It's your money. You deserve to know what's at stake. Right now, taxes are historically low, but they won't be this low forever. So call the McLean Advisory Group team today so you don't miss out on this opportunity. 609-488-4646. That's 609-488-4646. You work hard for your money, and we'll work just as hard to help you keep it. McLean Advisory Group, 609-488-4646. Investment advisory services offered through Sound Income Strategies, LLC, an SEC-registered investment advisory firm. McLean Tax Advisory Group and Sound Income Strategies are not associated entities.
I'm on the fence about a real tree.
I've done the real tree. When you have that fake one that's in 3 different pieces, you just bust it out every year and you take a second and it's already got the lights attached to plug it in and boom.
You like the smell. I do like the smell of those Christmas trees.
Yeah, but you can get that smell, in different ways. But anyways.
This is Financial Insanity with Scott McLean, presented by McLean Advisory Group.
We are talking today about income investing versus growth investing and making sure that people don't make the mistake of not turning off that faucet of the growth investing and turning it on to income investing in retirement like you should. I'm Alex Dingman along with Scott McLean, McLean Advisory Group. As we talk about things and it raises some questions for you, that number 609-488-4646. 609-488-4646. Now, Scott, both types of this investing can be impacted by the stock market, whether it's income or growth investing. And
that's right.
How does volatility play into all this, Scott?
Well, they could be volatile. We just noticed the interest rates screaming in 2023 to 2024. The market shot up. And we even heard banks falling apart because they were buying the banks were buying guaranteed bonds at 1-2%, but now we're buying bonds at 4 or 5%, and the banks were actually starting having problems. We heard of that throughout the news. Now, investing for income is a different mindset. It's like the chicken and the egg we spoke about before, Alex, where the chicken pops out the eggs. You can either eat it, go out and spend, go out to dinner, enjoy the dividends or interest. Or maybe you say, I really don't need it. I've got my pension, my Social Security. I don't really need it. I'll just take the dividends, the eggs, and we're going to go ahead and continue to reinvest those dividends and buy another chicken by buying another tool. So to make it clear, we're looking for not growth like the S&P 500 we spoke about, or the Dow Jones or the NASDAQ growth stocks. We see the NASDAQ, the tech stocks are doing tremendously well at certain periods of time. But income tools, let me go over those quickly, Alex, because it's a forgotten art. Is that okay if I go through a few of the tools?
Yeah, please do.
We're talking about bonds, individual bonds, corporate bonds, not ETFs, exchange-traded funds, not mutual funds, which you can buy bond-like, but I mean specific bonds that give you the yield that tells you how long it's going to be paid for. So individual bonds, preferred stocks. It kind of smells like a bond, but it's a preferred stock, which gives you a higher return. Real estate investment trust, REITs, different types out there. Business development corporations, BDCs, wonderful when the interest rates shot up. They're paying tremendous dividends. And then you have master limited partnership, MLPs. Now, all of those tools, whether they pay you twice a year, 4 times a year, or monthly, this is income that can really cushion the blow. As you said, Alex, if the market drops volatile, well, they could cushion the blow because you're still getting paid by way of dividend or interest for the risk. Where in the stock market area, the stock's going to go up and it's going to go down. And one day you're happy, the next day you're sad. It's almost like taking Prozac. You probably need it for some people and you can't handle it. And therefore, I can tell you the stock market changes people's personalities. But with a steady dividend or steady interest, you can bank on that coming in on a consistency. And so I can tell you, it's a steady stream of income that you want to look for, Alex.
Yeah, absolutely. As we're talking about income investing versus growth investing today on Financial Insanity, the number 609-488-4646, 609-488-4646. If you have questions about anything that we are talking about today, I'm Alex Dingman alongside Scott McLean of McLean Advisory Group. And so very simply, if you're somebody, you're an investor, you're looking for more peace of mind, you're going to go with the income investing route, right? That's right, a little less volatile, and it means, not as high at peaks, but also when it dips, you're not going to experience that as much as also. And
you'll also enjoy the dividend if it does drop.
Right.
Because we did see the income in the early parts of later parts of 23 and 2024. We saw them drop. Actually, the income portfolios as well as stock portfolio dropped by about 20 to 30%. They did drop. But did you get a hug and a kiss, a dividend or an interest payment? Did you get that? And in the growth area, you didn't get it, most likely. But the question is whether you like pizza delivered to your door every single day of the week. Well, you might want different toppings. That's why there's so many different types of income-producing tools as well as growth tools, Alex. So we can talk about some examples in a minute, but I think this is really important for people that are investing where you're near or heading into retirement. The real question is going to be, okay, I'm near and in retirement. Where do I change? And this is where you have to start changing or understanding the philosophy before you do it, not having some investing person just throw you into it. You need to understand the difference between growth and income.
Well, and Scott, when you have folks come in, I'm sure this is something that you can explain to folks. And one way to go about it is just helping them understand, hey, the paychecks are going to stop. And this is a way, like with the pizza analogy, you're going to know that pizza is coming. You might not know what the toppings are, but hey, you love pizza. Pizza is coming, and it's going to be steady. And who doesn't like that steadiness, that regular income? And so I think that's the one thing I'm sure that you hit on with folks is just talking about, hey, that paycheck, that was always nice to have, right? Coming every couple weeks or whenever it might have been. And this is now going to replace that, these different strategies that can help folks obviously continue having that income in retirement.
It's really important. It's a good way to either A, grow your portfolio by way of extra dividends, purchasing more stock at lower prices or higher prices, or receiving, as you say, that steady check is going to show up in the mailbox on a monthly, quarterly, semi-annual basis. You can bank on having that money come in, provided the company doesn't fold. That's why you want to follow up with good, solid companies. But I think about a girl named Jane when she invested in a mixed dividend-paying stocks, bonds, REITs, MLPs, and every month she received throughout the entire portfolio a nice little check. At the end of the year, she's enjoying life, her and her husband, but of course, they know that dividend's coming in. It's reliable. Maybe you bought a house and you have a tenant paying you on a good tenant, by the way, Alex.
Yeah,
a good tenant paying a consistent
it's an important distinction.
Exactly right. And it's in a good neighborhood, so the price of the house might vacillate, go up and down, but the tenant is going to pay their rent, and you can bank on it. That's what's so nice about it. But again, you have different areas, so common sense says, do I need growth or do I need income? Everyone is different. We're all different, I can promise you. But the question is, what are your needs? And they could be, I want growth right now, but maybe I need to change later on in life. Or maybe your husband or wife passed away. You lost one of the two of the Social Securities. Now you need to make it up. This could be a good way of diversifying your portfolio.
Well, and Scott, talk to me a little bit about how this conversation you have with folks when it comes to income versus growth and getting people into this income investing mindset in retirement, but how this plays into your 3D approach with folks as we talk about the dreams, the dollars, the dynasty. These are the kind of things you got to get set up as you're nearing retirement, entering retirement, so that you can fulfill all of those aspects of that 3D approach, Scott.
The dreams are so important when we talk to people and, what you want your retirement to look like. So I call it the go-go years. In the early years, you want to go 100 miles an hour. You got vigor, energy, you and your sweetie or you and your partner or whomever, you're going to go out there and enjoy life. And so it's going to maybe cost a little bit more money than you thought. But then as you plan it out, maybe you have another bucket that's in a growth bucket. So I might use that money for later down the line I might need income later, another 10 years from now. So again, how you design the dreams dreams do change, by the way. It's called health issues. It's called income issues. It's called maybe your spouse, partner had passed away. Those numbers can change. That's why when you do the 3D approach, looking at all the scenarios, using the worst case, best case scenario, which I know most of our listeners always do. What's the worst case? Like when you're selling a business, maybe is my son daughter taking the business over? What's going to happen? What does it look like? What if they don't take it over? These are the dreams. And then, of course, the dollars. Well, okay, now we're going to, how's the income going to come in? If I sell my business to my son or my daughter, if I sell the business out, what am I going to do? This is the hard part, followed by the dynasty. Who gets what I have? How do they get what I have? We just had a meeting with a couple right now. Their son's disabled. They're taking care of their son, just recently happened. And now we're figuring out, okay, how do we put the money? Who's the beneficiary? How do we protect the money? How do we make the money come out on a consistent basis? Who's going to be the executor of the estate if my other son or daughter pass away? Who's going to be the power of attorney for my son that's disabled? Who's going to dole out the money? These are questions that you may not have now, but if they do, we want to have that conversation with our clients because, again, if the dividend or the growth is happening, maybe the dividends, the eggs are still coming out, it's the dynasty. Who's going to get what you have? And how do we keep the money from your favorite uncle, Sam, who wants a piece of your wallet? How do we reduce that? And these are significant areas that we need to pay attention to on a yearly basis, if not a quarterly basis. And if you have elections coming up, it could change as well. If we have a new president, the sunset law comes off in 2025. How does it fit into our game plan? What should I do? And if you're out there right now and I'm not understanding what's happening at this point in time, I can promise you the best number I could give you is 609-488-4646. That's my number. Not a ploy to do business, but a ploy to say ask questions. There's nothing being blindsided with new tax rules and tax laws and issues coming up. And if you are blindsided, how do you take care of it if you can? There's nothing worse than procrastination. And I can tell you, if you keep procrastinating, it could catch you off guard. So again, investing for income versus growth. How are you positioned out there, Alex? How are they? Remember, the market soared in 2000. And then, of course, 2000 to 2002, it dropped. Then it took off to 2007. It dropped again from 2007 to 2009. It came back. So from 2000 to 2013, the market pretty much went nowhere. Go on your computer, figure it out. Yahoo Finance is a great tool. Look at the charts. You'll see how can I have income versus growth? Where should I be? But again, we all like growth, Alex. So we need to balance the two approaches. By not balancing the two approaches, please listen to me. By not balancing these approaches, you could be saying, what am I doing? I'm not getting anywhere. Or maybe one year you made a lot of money, the next year you lost it. How do you really review your assets, your investments, your allocations? And this is why people call us all the time, Alex. They give our studios a call at 609-488-4646. I'd love to be able to clarify and really help you, guide you through these challenging times of now I've gotten older. I still think I'm young, but I have to maybe make a change. Change for what? The 3D approach, as you well said. My dollars, of course, your dreams, then my dollars, and then my dynasty. No one likes to talk about that, but we need to discuss it to protect your money for all the hard work you've done over your lifetime. I'd love to hear from you, and we have some tremendous materials for you at our website. But if I can help you, I'm here for those of you who really want to more dive into your situation. Maybe we'll put you on the radio with us. How's that?
That sounds fantastic. Again, that number 609-488-4646, 609-488-4646, added.com for the website. Talk today about income versus growth investing. And next, we're going to have some real-life examples.
This is Alex Dingman of Financial Insanity with Scott McLean, wishing you a happy holidays. I hope you have good health and get everything on your wish list. Thanks for listening.
Who likes uncertainty? Wall Street certainly does not. With near record inflation and partisan politics, there's a lot of uncertainty right now. What will America's future look like? What will your future look like? Will your taxes go up? Will your savings go down? For more than 40 years here in the Jersey Shore area, Scott McLean and the team at McLean Advisory Group have seen uncertainty come and go. No matter what the future holds, Scott can help you create a plan designed to preserve your finances in uncertain times. And it's not a matter of if those uncertain times will show up, but when. Call 609-488-4646 now to meet with Scott McLean and the team at McLean Advisory Group. If uncertainty is causing you to feel insecure, Scott McLean might be able to help. Call 609-488-4646 and schedule your visit today. Again, that's 609-488-4646.
4646.
Investment advisory services are offered through Sound Income Strategies, LLC. Investing involves risk, including the potential loss of principal.
By the way, I'm an old dog. I'm almost 65, but I will accept presents.
Scott, are you just going to plug your birthday every show until the first of the year? Is that what's going to happen?
I'm going to plug it till I get a present.
We made it back. This is Financial Insanity with Scott McLean, presented by McLean Advisory Group.
Thank you so much for joining us today. Another edition of Financial Insanity. I'm Alex Dingman alongside Scott McLean, McLean Advisory Group. If you have a question, the number 609-488-4646, 609-488-4646. Talking about income versus growth investing today. And Scott, we're going to do some real life examples here, so this will be fun. Let's start off here with maybe a story that illustrates the benefits of income investing. Can you do that for me?
Sure. This young woman and her husband, we might have mentioned earlier, Jane and Tom, came in. They invested in a mixed dividend portfolio. A portfolio could be a stock dividend portfolio as well as bonds, preferred stocks, real estate investment trusts, and MLPs. And every month, they're receiving a nice little check, a dividend. I've been saying this over and over again. Like the chicken and the egg, the dividend, the eggs keep popping out. They can choose to reinvest it or use it. In their case, they were using it. So when their cost of living went up, this really was a godsend for them. Why? Because they were getting a nice little check. And the checks were, in their case, they enjoyed it on a monthly basis. Now, we can design it any way they want, so it's a steady monthly basis, a steady amount. But they said whenever it pays a dividend, we want to receive it. Okay, we turned that spigot on. They didn't reinvest the dividends. They were eating the dividends. So they go out to dinner. They go out and have fun. They pay their electric bill, the gas bill. Inflationary times was really, really helpful. Almost like that tenant that's paying the real estate rent on your house, that's renting your house from you. It continually comes in. Now, diverse of that, the opposite of that, growth investing. So had you invested, let's say, in the S&P 500, the Standard & Poor's, or maybe the NASDAQ, the tech stocks, and Mike invested in tech stocks and small cap stocks, and over the years, the portfolio seemed to have some impressive gains. Now, think about it, because we've seen some gains in the AI movement lately. It's been screaming like could be the new age. But the challenge is it doesn't pay a dividend. Most of those stocks, the small cap stocks, the tech stocks, they're not made to pay. They're paid to reinvest, to buy more stocks. No, there's nothing. They don't reinvest. They're using their money when the company has a profit, and they're buying more technology or research and development. So in this case, when the stock market takes a tatter, a left hook, a tummy ache, you see the portfolio possibly going from, let's say, $300,000 to $260,000. That $40,000 drop seemed like the world's coming to an end. Now, if they can hang on there, then enjoy it. So what's the difference between Mike and Jane? Jane's got the consistent income coming in. Mike has to wait for the market. I call it growth versus income. So that's the biggest challenge. So that's a classic example of I want to have growth, and we all love growth. Let's make it real clear. I love watching some of the stocks in our portfolios. We have a designed portfolio, and yes, we are using AI to help us really get out the highest return possible. But the challenge is, what about income? Give our studios a call. Let's have a discussion, because I can tell you the fear of missing out could cause your portfolio to really cause you to go to the doctor and get more Pepto-Bismol or different types of medication, because I can tell you it's a volatile market. Now, if we had steady income and you're in retirement, different story. If you're young, go all in. It could be a great time to play in the market. But when you're into retirement or nearing retirement, your philosophy needs to change. And I can tell you, when we saw this period from 2000 to 2013, where we saw a maximum return around 20% over how many years? 13 years? What does that give you? Not very good growth. So again, balancing, Alex, the two approaches. And if you're out there, how do you balance it? This is where the expertise called duration of a bond portfolio or income of a steady stream of income. This is where you put your big boy pants on, big girl pants on and say, okay, where do I do? Can I change it? Understanding how these investment tools could really help, well, calm your nerves, especially if you're depending on income on a steady basis. But again, the 3D approach, your dreams, and then, of course, your dollars, and then the dynasty. This must fit, or I can tell you, you're going to have some challenges. And this is how you can really enjoy your family, your friends, knowing the steady stream of income could be just what you want in retirement, Alex.
That is Scott McLean, McLean Advisory Group, office located right here in Ocean County. That number again, 609-488-4646. If you have questions, maybe it's a first opinion, maybe it's a second opinion to see, am I set up for income in retirement? That number again, 609-488-4646. And Scott, I know you probably deal with this a little bit where people want to try to time the market. And, you know, you're someone, you've seen how it flows, and generally speaking, you're in the market for a while, it's going to probably be a good thing for you. But like you talked about, there are those dips. So how do you talk to folks that are looking at the numbers, they're looking at when they're going to retire, and maybe they're talking to you about trying to time the market? What would your suggestion there?
I would love to time the market, but my crystal ball is kind of hazy.
Yeah.
When I think it's going to go up, it goes down. And so you can use numbers. We're watching the VIX, VIX, called the volatility of the stock market. And when the VIX gets up to 30, it's a roaring, scary time. When the VIX drops down under 10, it's a very calm, patient time. And right now, the VIX right now, you're thinking, where are we at? So check out the VIX, the volatility index. And we look at that. So again, timing the market, it's time in the market, Alex. And so, but now that's an old statement. It's not timing the market, but time in the market. But when you're in retirement, the question is, how long are you going to live? Well, again, we're back to the VIX. I don't know. My mom died at 75. Daddy died at 74. Does that mean Scott's going to die at that age? Well, I daggum hope not. I want to live a good long time, but we don't know. So we're going to use what we have. Grandpa died at 84. Grandma died at 83. Okay, maybe I got an extra 10 years. We don't know. But again, how do we plan it out so we can have in the go-go years enough money? In the slow-go years, we might not need as much. And then in the no-go years, did it, done it, don't want to do it again, or I can't get around. Okay, now we're starting to pull out different types of income. This is what our discussion is of the dreams, your dollars, and hopefully you'll live a good long time and pass away real quick versus a nursing home. But now do we need to shift your money into a irrevocable trust, which, Alex, we've done a show on?
Yep.
How do we preserve your money? If those are out there listening right now, this is the 3 areas to really focus on: your dreams, your dollars, and your dynasty. Maybe you need to start shifting your assets for those people getting older into special trusts where the government can't put their hands on it or the nursing home can't grab your money, and protect it for your children or your charities.
If you have questions for Scott and his wonderful team here in Waretown, New Jersey, that number 609-488-4646, 609-488-4646. Next, we're going to be talking more about balancing the two approaches of income and growth investing. We're going to be talking about both of those strategies and how to use both. Coming up here on Financial Insanity.
Stop for a moment and think about this. Do you know how much money in your 401k or IRA is actually yours? Or will the government take a bigger chunk than you thought? Remember, you still might owe taxes on that money, but do you have a plan to help make sure you don't pay more than you should? At McLean Advisory Group, we believe you deserve to keep more of what you've earned, which is why we're here to help you navigate the confusing world of retirement taxes. It's your money. You deserve to know what's at stake. Right now, taxes are historically low, but they won't be this low forever. So call the McLean Advisory Group team today so you don't miss out on this opportunity. 609-488-4646. That's 609-488-4646. You work hard for your money, and we'll work just as hard to help you keep it. McLean Advisory Group, 609-488-4646. Investment advisory services offered through Sound Income Strategies, LLC, an SEC-registered investment advisory firm. McLean Tax Advisory Group and Sound Income Strategies are not associated entities.
Who likes uncertainty? Wall Street certainly does not. With near record inflation and partisan politics, there's a lot of uncertainty right now. What will America's future look like? What will your future look like? Will your taxes go up? Will your savings go down? For more than 40 years here in the Jersey Shore area, Scott McLean and the team at McLean Advisory Group have seen uncertainty come and go. No matter what the future holds, Scott can help you create a plan designed to preserve your finances in uncertain times. And it's not a matter of if those uncertain times will show up, but when. Call 609-488-4646 now to meet with Scott McLean and the team at McLean Advisory Group. If uncertainty is causing you to feel insecure, Scott McLean might be able to help. Call 609-488-4646 and schedule your visit today. Again, that's 609-488-4646.
Investment advisory services are offered through Sound Income Strategies, LLC. Investing involves risk, including the potential loss of principal.
Frankly, you could have your grandkids tweet out to your friends or go on the Facebook or Instagram or whatever it is and say, I got great information from Scott.
And you left out TikTok there as you're rambling off the different social media being used by the kids today. You got to remember that TikTok.
Oh, that's right. Tickety-tock.
This is Financial Insanity with Scott McLean, powered by McLean Advisory Group.
Talking today about investing in income versus growth on Financial Insanity. I'm Alex Dingman, alongside, as always, Scott McLean, McLean Advisory Group, office located here in Ocean County. And that number for you, if you have questions, 609-488-4646, 609-488-4646. All right, so we're going to be talking about balancing the two approaches here, income, growth, investing. And you know, both have their merits, Scott. Both have their place, but
they do.
But how do you decide which strategy is the right one for you?
You know, if you're listening to me and we've heard the first part of our show, this is so important. I'd like to throw it out there, Alex. There's a book out there called Return on Principle. This is a very, very close friend of mine, and David Scranton. He's got more degrees than the thermometer. He talks about the return on principle, 7 core values to help protect your money in good times and bad. I'd like to offer that to anybody who would like that book. You come in to visit with our firm. I'll get you a copy, totally complimentary. Anybody who visits with us, no shake, no harm, no foul. You don't have to do business with it, but just pop in. Let's have a discussion. Why? It goes in depth. It goes in depth of balancing the two approaches of income and growth we've been talking about. And Alex, we talk about the growth, which is more volatile, versus income, more consistent. I didn't say the stock market goes up and down, because it does. That's given. Well, we talk about the risk. How much risk can you handle? The time horizon. When I meet with people, I said, well, if you have $500,000, or some of you have $100,000, so it doesn't matter. The question's the same. If the market took your $100,000 and it went to $80,000, what are you going to say to me? I'm trying to find out what we call this in the world, the beta, the risk factor. So when you met with your advisor and he or she went over your risk profile, not the stinking comment, are you conservative, are you moderate, or are you aggressive? That is just a beginning. But now we've got to dive down, and we need to really study the Greek or the formulas. When I studied Greek in college, and I was looking at it, I was like, okay, words mean things. When I said your portfolio went from 100,000 to 80,000, you said, oh, I can't handle it. That tells me something. I'm watching your body language. This is the dreams. Or maybe your 500,000 went to $460,000. Less of a percentage drop, by the way. So when I ask those questions, I need to ask another question. When you met with your financial advisor and he or she went over the risk factors and they said, are you conservative? Let me give you an illustration, Alex. As a fighter pilot, For over 30 years, I can dive the plane. I can roll the plane. Now, you're in the back with me. Audience, you're in the back with me. Stay with me. And I've been doing it for 30 years. My track record's impeccable. And I roll the plane. I yaw the plane. It goes sideways. I spin the plane. We are having... No. I am having a wonderful time. You're in the back. Perhaps some of you listening right now, you need a bag to take with you, if you know what I'm talking about, to give up some of your goodies. But my question is, are you conservative, moderate, or aggressive? No. Listen to me. Is your financial advisor conservative, moderate, or aggressive? No. Wait a minute. Whoa. Is Scott, 30 years, flying, diving, rolling, well-trained in the field of flying? Would you say, Scott, Alex, let me ask you the question for the audience. Am I conservative, moderate, or aggressive? Would you think I'm aggressive?
I mean, I think you're tactfully aggressive. Sure.
Sure I am.
Yeah.
But in my mind, Alex, as your financial advisor, in my mind, I'm conservative. Why? I know what I'm doing. I know what's going on. I know where we're going. I know when the wind blows one way, if the engine goes out, if a wheel, we saw Boeing one time, a wheels fell off. What is the definition of conservative? You need to ask this to your advisor. What is you, listening to me right now, what is your definition of conservative? That's why I ask these questions. If the market dropped a certain, how would you feel? What's going on? The other question would be, okay, if the market went up, your 100,000 went to 120, but my portfolio went up to 105, are you upset? That's a 5% return versus a 20% return. Are you upset? Oh, no, I'm fine. I can tell you when you're playing mahjong with your friends at the table or pinochle, or maybe you're playing the racquetball or whatever, the pickleball, I guess the question's going to be, hey, my portfolio did 20, and now you're thinking, oh, I only did 5, and now you're upset. I need to understand, as a fighter pilot of 30 years, knowing I'm doing, it's not Scott's opinion. I need to know, your advisor, if you're listening to me, your advisor needs to define what your definition of conservative is, not my definition. Because in all fairness, you thought I was aggressive, but to me, I'm not. Understanding the definition of conservative, moderate, and aggressive, and then putting numbers to it could tell you, is it time to change my advisor? Maybe I need to move from the growth position to the income position. Maybe I need those chickens that are laying the eggs, and I'd like to have more income coming in. If they're not built that way and understand, which is a lost art, it's a very much lost art of income producing, which is why I recommend it. If you'd like to get a copy of my very close friend for now over 20 plus years, David Scranton's book, Return on Principle, the 7 core values of help protect your money in good times and bad. I can tell you that's what you get when you visit with McLean Advisory Group. How to guide you through this quagmire of decisions. Do I take Social Security? Do I wait for Social Security? What pension option do I take? What income option do I take? Where do I invest my money? Because all your life you're investing for growth, but now you're shifting to income. Why? And understanding, if you're listening to me right now, please don't put this off. Putting your head in the sand is like an ostrich. Your vitals are exposed. Your dollars are exposed. Understanding how the investments work for you. You may be totally different than your neighbor who got a 20% return, but you're happy with a 5% return. I'm not saying which is good or bad. But again, if you're looking for consistency, the steady, balanced approach, as Alex, you mentioned, and how do we invest this money, this is so critical. Especially in times, which we'll get to in a second, Alex, the legal questions and the tax questions, when you're starting to pull income out. Where do you pull it from? What investments do you pull it from? And how do you pull it? Especially those of you listening to me that are 73 and older, now you're taking your requirement of distributions. How do those investments get invested so you don't eat the principal faster than what you could be?
And if you have questions about anything we're talking about today, that number, 609-488-4646. Again, 609-488-4646. Maybe you have a question about something we're talking today. Maybe you're questioning whether or not you should get a second opinion. Are you sitting there thinking, am I correctly set up for income in retirement? Well, Scott and his team at McLean Advisory Group here in Waretown, New Jersey, would be happy to look over your portfolio, to check everything out, and to help maybe give you some guidance moving forward, because that's what it's all about, Scott. You're just trying to help people to understand, okay, what is it that you're wanting to accomplish in retirement, and then you helping them set a path and putting things in place that'll help them get there and maybe help them have a little bit more peace of mind throughout the process of knowing that they're getting this steady money as well, because you don't want to be overly concerned about finances in retirement if you don't have to be. You don't want to be worried about outliving your money. And so it's the kind of situation, Scott, where you can come in, you can have the eyes on the situation and really just give the best guidance you can to make sure, whether it's growth, whether it's investing for income, whatever it is, you're going to help guide them in the right direction.
That is well said, Alex. I can tell you it's hard to make the decisions, but it's nothing better than understanding the array of choices where most brokers are going to sell stocks. That's what they do. Stock brokers sell stock. That's what they do. But when you look at the whole picture of the portfolio, now we're going to look at, okay, what other types of investments are out there? When you go to the buffet table, some people go to the ice cream stand first, or others going to go to the meat and potatoes. Well, everybody's different, and there's nothing wrong with that. God has made us so beautifully, wonderfully made. We're fearfully made. The question is, what is right for you? Not your friends telling you what to do. When do I take Social Security? What does your portfolio tell you? What options should I take in my pension? What does it options show? So when you look at all the options when it comes into retirement, this is where, when you take the picture of the holistic approach, looking at the dreams, and then the dollars and how they get moved around, and then the dynasty, how do they get passed on? This is critical. Let's just give an example, Alex. Now, here I am. I'm 73. I'm taking out, let's say, 4% from my required minimum distribution, and you have a growth portfolio. The market dropped like it did in 2022, about 20-something percent, and you've got to take it out of your principal. You have to take it out, or you're going to get a 50% penalty if you don't take it out. But what if you had a dividend portfolio, and the dividend portfolio was spitting out a nice 4.5% to 5% dividend? Well, now you're taking it out of the dividends. You're not having to sell shares of stock at a reduced price because you'll have to sell a lot more shares. What a great way to take out your required minimum distribution. And now we're talking about taxation. So when your portfolio is spitting out nice dividends or maybe nice growth, and your advisor reviewed the tax return in addition to the portfolio, how did he or she look at both areas and say, this is where we should take the money from, not this area? This is how you want to buy a new car? Let's take it out of this portfolio, not this portfolio, because you could be taxed at a 15% bracket versus a 5% bracket. Alex, when you go to the chess match, you look at all the pieces on the table and figure out where to move them for the best optimization for the portfolio to last a good long time. And so you can put your head on your pillow and you can sleep well at night knowing that you've looked at all areas, not just one area. And this is the mistake in the financial planning world, which is when I wrote the book, The Three Blind Mice, how the financial planning process leads your money to a mousetrap. It's because the financial advisor didn't speak to the lawyer, the accountant, or his portfolio as one beautiful orchestra of music for lasting a long time for your retirement. That's right, you out there. If you have any questions, I implore you to call our studios. No cost, no obligation. 609-488-4646. 609-488-4646. And I can tell you the time we spend together will be well worthwhile.
Scott, great show today, my friend. That was a lot of fun, and I think really valuable for folks.
Well, thanks, Alex, for bringing it up. I appreciate you because we're getting a lot of phone calls on this right now, and I want to thank you for telling me to really hone in on it.
No, that's great. And all the listeners out there, we really appreciate you, and you all have a great week. We'll talk to you next week.
Hey, this is Scott McLean. I want to wish you guys a tremendous, wonderful holiday. Merry Christmas, Happy Hanukkah, and all the lovely greetings we have for you. Proud to be in your life as we try to give you the financial information so you don't go insane. Happy holidays.
This radio program may contain information which has gone regulatory or other significant changes since its original recording. The information and views expressed on today's show is educational in nature and is not intended to be a recommendation for any specific investment, product, strategy, plan, tax, or legal advice. Information presented is believed to be factual and up to date, but we do not guarantee its accuracy. Investment advisory services offered through Sound Income Strategies, LLC, a SEC-registered investment advisory firm. McLean Advisory Group and Sound Income Strategies, LLC, are not associated entities.
This radio show is a paid placement.